macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
It's time to place your bets, folks. Here we are at S&P 1600, ahead of a big Friday jobs number that's certainly going to have some fireworks. And where do you stand? Are we going to see S&P 1700 before 1500, or is the correction going to continue to 1500? I'm going to show you a few charts that might be able to help you think about this. And as we bump up against the 50-day moving average on the S&P, where it can't seem to get through, Friday is going to be a big mover for us. So let's go to my first chart. Russell 2000 showing up as the strong leader here, back above its 50-day moving average here, and filled this gap from mid-late June. Some people would think it would roll over from here, but you can't argue with this kind of strength. So the Qs couldn't get above their 50-day moving average either. We'll come back to moving averages in a moment. Now I want to show you a couple of sentiment charts. Basically, I'm going to show you charts that stood out to me this week. I look at a lot of price charts, but I also like to see other strategists, economists, traders, thinkers put together data in unique ways. So let's take a look at a couple of these. This is the National Association of Active Investment Managers Sentiment Survey. Now, this survey has been around only since about 2005, but it tends to be some of the smarter money, because these are guys not just writing newsletters, but they're actual money managers. Now, they may not be institutional size of 100 million or greater, but collectively you're talking about a lot of small active money managers that are willing to participate in this survey. What's interesting about this data since 2011, these guys have been right a lot of times. You look at the rally coming out of the October lows in 2011. As a group, these guys were right there. They picked a correction into 2012, also here. Now look at this dichotomy here. I showed this. I was amazed to see this chart in mid-June when these guys were down below 60%. Basically, this is like their net long level. If you look at them in the aggregate, where do they stand? This is like they're calling for a correction here. And this data is probably as of the end of June. They're all the way down here below 40% bullishness, as their average rating, while the market's way up here. Now, are they right this time? That's the question. They tend to be the smarter money, and maybe they share the thesis that I've had as we came into June, that, hey, we're headed into summer, we've got a lot of big gains on the table, the Fed added volatility, and it set up the recipe, so to speak, for a sideways summer trade. And maybe that's what a lot of these guys have done is, hey, let's bank the profits and get ready to go on vacation. All right, next I want to show you this whole margin debt thing. Now, this is from Doug Short. Doug Short is sort of a bear, but he's a quant, so he looks at a lot of different data points. And here's his take on the margin balance issue. This is a very unique chart. There's a lot going on here, but basically, if you're above the zero line here, things are green. Investors have positive credit balances. Down here, they have negative credit balances. When has this happened in the past? The tech bubble of 2000, big negative, a lot of traders on margin, and a lot of people got hurt. The market had to correct. Comparing now to 2007, look where we are. Margin debt has exceeded the 2007 levels. And somebody like Doug would have a thesis that, the Fed might tap the brakes just to get this realigned, to get people, hey, get off margin a little bit, raise your cash balance, and they could have that sort of effect if they watch this same kind of thing. And I'm sure the Fed watches this data closely too. All right, next up, let's look at, this is the Investors Intelligence Survey. And I got this from Ryan Dietrich at Schaefer's. They look at this data a lot. This is going back to 2009. So the blue line is the percentage of investor intelligence newsletter writers who are calling for a correction. And you notice we're above this 35% level. So this 35% level, when investors intelligence newsletter writers have gotten this bearish, it's actually been something of a turning point for the market. You see the market bottomed here in the first correction we had in 2012. So I'm looking right here, big peak in correction callers, in the newsletter writers, that was a bottom. Same thing again here into the the fall swoon that we had before the election and fiscal cliff stuff. Big surge in correction callers up to 35%. That was where the market bottomed. Same thing again here. This is this is the April swoon, so to speak, in the market, because this is the S&P 500 line here. And Investors Intelligence as a group, 35%, over 35%, we're calling for a correction. Here we are back at that level. So, is this a turning point and strength for the market, as a contrary indicator when you have the National Association of Investment Managers running for the hills and the Investors Intelligence newsletter writers running for the hills too. All right, our last chart today, the percentage of stocks in the S&P 500 above their 200-day moving average. I showed this one last week in an article I wrote that's on the site, and I only showed basically the past 15 months because I wanted to show how we barely dipped down to 75% of S&P stocks above their 200-day moving average, compared to the two corrections of 2012, where that both breached 50% of stocks above their 200-day moving average. So I thought that kind of stood out, that we were barely in any kind of correction territory here, and we had a 7% correction, however you want to look at it. If you want to use the extreme intraday high of 1687 down to 1560, that's a 7.5% correction. If you just want to use a close below 1675 down to 1560, that's more like a 6.5%. So I'm calling it, basically, we've had a 7% correction. And if you saw the video I did in February on parabolic rallies and perpetual tops, where I studied those big moves in 2006 into 2007 for 330 points and about a 30% rally, and then again in 2010, 2011, another 330 points in the S&P and about a 25% rally. What both of those big rallies had in common, besides that 330 points and about 25 to 30%, is that their biggest corrections were 6.8% each in the 06-07 and 10-11 parabolic rallies. Well, this rally already made it surge, over 330 points, 25% off the November lows, and we got our correction at the top, whereas those previous corrections happened in the middle of their rallies. We got ours here at the top. I'm wondering if this correction is not over yet, especially when I look at this chart. You go back to 2011. Well, of course, this was devastating because this was a 20% correction. So, of course, you're going to go down to below 10% of stocks, only 10% of stocks trading above their 200-day moving average. Back here, you get just a peek at the 2010 correction, which was still, at its nadir, got down to probably 25-30% of stocks above their 200-day moving average. So this is one to keep an eye on if this is going to roll over, along with lots of other charts you might want to look at. So in conclusion, I'm not painting a bearish picture, but I am cautious here, looking for the correction to continue before we make new highs. And if we get a terrific, strong jobs number on Friday, that's great economic news, but I don't think that moves us significantly higher above, say, S&P 1650 right away. All right, that's your 5 charts in about 10 minutes, I hope. I got it under 10 minutes. Looking a little scruffy here, headed into the July 4th holiday. I hope you guys have a safe one and enjoy, and I'll see you next week.